What's going on, folks? In today's video, we are covering Costco. Now, this is a place you definitely know because there's a lot of great deals over there and the fashion is questionable. So, with Costco, let's dive into what this company is all about. And then by the end of this video, you'll know if it's a decent stock to potentially pick up, considering that their earnings are just right around the corner. So, I like to do videos right before earnings because it kind of gives you the insight of where this company stands. Because when earnings come out, folks, that is when the company stock price likes to go up or down erratic. So what we want to try to do, folks, is try to get ahead of the curve and figure out what this company is actually doing right or wrong. So that way, if it's in our buy zone, we can strike at it before it kind of gets crazy. So with Costco, I'm going to just pull it up here. They did pretty well. Actually, the last little bit of the earnings has been a little bit shaky here, just on Yahoo Finance. So the last year has been either positive, negative, positive, negative. Earnings obviously coming out on the 26th that I just mentioned. But this is a business that Charlie Munger really loves. He has it a part of his portfolio for quite some time, and I don't think he's ever going to sell. But I'm going to pull this up in the StockSpec software here. This is a software I like to use to screen these companies. But let's take a look at what's going on with this business. So right off the top, I'm seeing a lot of positive and rather premium action here on the price earnings ratio. For the last 5-year average, it was 37.43, and currently it's at 41.32. Now, obviously, this is not the only and sole metrics to look at for when it comes to different businesses. But it's something to keep in mind that if you're buying Costco, most likely you are paying a premium. We want to find companies that have a price to earnings ratio of 22.5 and lower. That for us is a more safer multiple to look at. Costco, a little bit of a premium, but listen, it's a company that's weathered many storms, and ultimately throughout the whole COVID pandemic, due to government response wherever you live, it did extremely well, and it's going to continue to potentially do well due to high inflation, where a lot of people, wealthy or not, are turning towards buying at Costco. So back to the numerics of this business, we've seen that over the last little while we've had an upswing in stock price. On the top end, it's been at 571.16, and at the low end 447.90. 447.90, and currently we're sitting at $558.59, up to the we're at the top end of our price range. And on the score here for the financial valuation, so for those who are new to the channel, this software here grades the company on a score of 1 to 10 based off how strong they are financially, based off their balance sheets, and looking at different average and other metrics. So with Costco, they're actually done extremely well. Like, it's a 7 out of 10. So they're only getting docked in 3 different categories. One being the price earnings ratio that we just discussed. Second, their current ratio, which is sitting at a 1.08. Not the worst. It just indicates to us that they only have a fair current ratio where they can cover for each one of their liabilities. They only have one asset. If you want to just break it down like that, we want to find companies that have a 2-to-1 ratio. That way you have companies that have enough assets to cover those liabilities with some more assets left over. So I'm just trying to really simplify it here. But 1-to-1, not the best, especially when you have high inflation, high interest rates, where the economy is kind of like in this limbo zone. We don't like that. So that, along with a share dilution of 0.13% increase over the last 5 years. Honestly, the software is very stringent, but it's very much close to zero. And I'm just pointing at this indication right here. Share dilution. So Costco has been, oh my god, I can't speak today, but Costco has been diluting shareholders over the last 5 years. It's a very small dilution, but ultimately, when companies do this, that means you're effectively owning less of the business because they're making the pie bigger and your slice is smaller. Well, that's the simple way to understand that. Other than that, they have a really healthy return on equity. They have a really high EPS growth over the last 5 years. Debt to equity is sitting below 50%. So that means they're funneling a lot of their operations through equity and not by taking on debt. So, which is positive to see. Their net income's up, free cash flow is up, and revenue growth is up as well. Those are the 3 things, the trifecta that you want to look for in a business at the very least. Are those 3 things going up? If they are, amazing. along with a decently high return on invested capital, sitting at 16.33%. I don't know why I said 16.33%. Those are all great numerics. Honestly, based off that, I'm liking Costco already. I can deal with the high price earnings ratio. I can deal with the low share the increase in share dilution. The current ratio, it doesn't bother me too much. But if I had to point out any of the red flags, that would probably be the number one thing. Because here's the thing, folks, with the price earnings ratio being high, if the stock price comes down, then obviously that price earnings ratio will shrink as well. The current ratio, though, however, won't. So that's something to keep in mind. Now, if you are a dividend investor, something to keep in mind with Costco, they do pay out a dividend, and that's 0.69%, nice, of a yield that gets paid out every single year. And that works out to being $1.5 billion in dividends paid out. Now, if you're wondering, how do you grade a company if it's a good dividend stock or not? Well, take a look at this. Their 5-year average free cash flow is $4.2 billion. Now, that is crucial to look at because we want to make sure that with the free cash flow that we have, can we pay out those dividends? Free cash flow is ultimately the hottest currency that a company can provide. It's where they can do a multitude of different things. One being paying out dividends, one being paying down debt, and a lot of other different operations. It's essentially like it's cash. As you can go to the store and pay for things for cash. The same thing applies to a company. Without cash, and cash being king, you might be in trouble. So with Costco, it can easily pay off the dividend, so that is extremely safe. Along with the free cash flow for the trailing 12 months is $5.82 billion. So they're above their 5-year average. Phenomenal. So that being said, that is something to take a look at. If you're looking at a solid dividend business, this might be right up your alley, along with some appreciation. Also, their Allman Z-score is extremely high, and if you do not know what an Allman Z-score is, it just measures the likelihood of a company going bankrupt. Now, 1.8 to 3 is where, 1.8 to 2.9 is where companies are in a gray zone, where they're kind of neither here nor there. However, 3 and beyond, a company is safe. 1.8 and below, that means the company is in distress, and you kind of want to avoid companies like that because that just means that they are at risk of potentially going bankrupt. Costco score is 7.78. Now, that means I love when I get interrupted by notifications, but that means that they are extremely safe from bankruptcy, and it's evident here, folks. Like, over the last 5 years, they've done extremely well, as I mentioned. So I have no doubt in my mind that they would be anywhere near a risk of bankruptcy. So 7.78, solid. They have a solid Piotrowski score, which is phenomenal. So everything's looking pretty good with Costco. The only red flags that I've seen so far is the price earnings ratio being a little bit steep, the current ratio being a little bit low, and the share dilution, which I can get around because it's so minuscule. Now, here's the other section of the software. Now, this is the price analysis section. Now, this software here allows you to input what you believe that this company might do over the next 10 years, utilizing numbers that they've done in the past. Now, obviously, past performance isn't indicative of future performance. However, we can give ourselves an educated guess based off the trends that this company's done over the last 10 years and try to forecast that out from 1 to 20 years to try to figure out what that intrinsic value may be. I'm going to do that just right now, but before I do that, if you're finding this video helpful, hit that like button and subscribe button because it means a lot to me and it means a lot to the channel. The software I'm using that's pulling out all this information for me is called StockSpect, and you can find a link in the description box below. It's a 7-day free trial that allows you to analyze companies quickly and effectively, and you don't have to wait for me to make a video. You can type in whatever company you like, and it goes on all US exchanges, all Canadian exchanges, as well as Euronext exchanges as well. And we're implementing more features to come. And so it's in the beginning stages, but there's so much value, and I'm only just scratching the surface. This is obviously the main page, but we have income statements going back 10 years of financial data, cash flow statements, as well as balance sheets. So we have financial statements for 10 years, going 10 years back, along with a charts section to see everything more visually appealing if you don't like the look of balance sheets. So even up to the top 10 institutional holders, and there's more information to come. We are just getting started. Now, go back to the stock specs page here. Here's what I've done. Now, if you're new to the channel, here's my spiel. I'm very conservative when I put my numbers in. So I've done some conservative revenue growth based off of what they've shown, along with very similar profit margins and free cash flow margins. So I put my numbers in here. I did 5, 10, 15% revenue growth based off the 1 year. So I put that on the aggressive side, 10 for the moderate, and 5 for conservative. Now, profit margin, I kept it very similar to what they've done over the last 10 years. Same thing with free cash flow. And price to free cash flow and price to earnings ratio, I put it at numbers that I believe are the most fair in regards to a fair multiple. 42 for price to free cash flow and 41 for PE ratio obviously is high. So sitting anywhere below 20 is somewhere where you want to be, and that's where I recommend if you ever use the software, or rather when you use the software. 14, 16, and 18 seem to be the magic numbers, I believe, if you want to pay for something a little bit more conservatively and something that makes sense. Desired return of 13%, I'm going to hit calculate. Now this is going to crunch all of those numbers, and then it's going to go through all the math, and it's going to spit out a number what we should be paying for this company today. Current price is $558, as I said. Now, yeah, we're working on getting this faster, folks, but take a look at this. Average calculation, and I'm also forecasting out 10 years, just something to keep in mind. Average calculations comes out to be $344.46. Now, the aggressive average, if you believe these numbers, $628, $447 on the low end, $854 on the high end, based off a price to earnings ratio model. Now, that's something also to keep in mind. But if you believe this 15% growth rate over the next 10 years, this company might just be a buy for you. However, I truly think it's somewhere between this moderate and aggressive average. I don't think it's as low as 287, but just something to keep in mind. Like right now, the price earnings ratio is about 41. So cutting the PE ratio in half, maybe, yeah, it should probably be around $300. And that's pretty close to it. So it might be just in here based off those metrics alone. Now, you may not be the value-oriented investor and you say, well, Leo, you know what? I really don't care if it's going to drop to that price. Why not just get into it now? And by all means, get into it. If you just want to go based off of the fact that it's a strong business and everything is going up and going right, yeah, don't wait for the earnings. Just jump in. That's my opinion. It's not my financial advice. But, and none of this is financial advice. It's just my opinions on things. But ultimately, on the channel, we like to try to find companies that are trading below fair value. That way we have enough margin of safety, so that way if anything goes wrong, we don't lose as much. So for Costco, me personally, love the business. I think it's great. However, I do think if you were to get in now, you'd be making a mistake based off the fact that you'd be overpaying for those earnings. And ultimately, a great investment is something where you can pay less for and get more. So folks, that's the video on Costco. Found it helpful. Hit the like button and subscribe button. I'll see you in the next one. Thank you so much for watching, and good luck when the earnings come out.